Could Bitcoin dip to $75,000? Let's talk about it. Before we dive in, make sure to like the video and subscribe to the channel. And if you want to join our community, head over to millionairesgold.com. We're now open for founding members at just $4.99 a month. For our YouTube viewers, we've got a special promo code, ET10. Use it to get an extra 10% off your membership. The link is right there in the description below. Now, let's get into today's topic. Right now, Bitcoin is trading around $100,000. It has touched $125,000, but let's be smart. We always build in a margin of safety. That puts our realistic reference point just above $100,000, and that's where we stand today. Here's the truth. Bitcoin doesn't move in a straight line. History shows us corrections of 30% to 50% even during bull runs. Could it dip to $75,000? Plausible, possible. But it's not guaranteed. Nothing in crypto ever is. And here's the key. This is not the end of the cycle. This is the market breathing, adjusting, and setting itself up for the next surge. So if Bitcoin corrects, this is our chance to think strategically, not panic. If it slips below $90,000, that's where we start positioning carefully, step by step, even if it slides towards $75,000. Because here's the math, the history, the pattern. The next major floor, like $55,000, is far behind us, and the next peak, potentially around $150,000. That's where the odds are stacked. Let's break it down. The market is human, fear, greed, euphoria. Corrections aren't setbacks. They're the rhythm, the prep work for the next bull run. And the ones who win are those who see opportunity in the dip, not fear in the fall. Here's how we ride this wave smartly. Recognize corrections and understand they are part of the natural cycle. Position strategically and use dips to build strength. Control emotions because panic is the enemy, discipline is the ally. Corrections happen. They are normal. Strategy always beats emotion. And remember, this is not a prediction, not financial advice. It's education, preparation, and perspective. But if we follow the patterns, understand the cycles, and move with clarity and purpose, we position ourselves to ride volatility toward opportunity. We're not spectators, we're surfers of the market. We're not afraid of the dip, we use it, and we ride it all the way toward the next peak. Discipline, awareness, strategy. That's how we turn a correction into the next step toward $150,000 and beyond. Listen up. Right now, there's a lot of chatter about Bitcoin and its market cycles. Some people are saying, the Bitcoin cycle is over. Institutions have taken over. Let's separate noise from insight. Yes, the market has evolved. Institutions are participating, but that does not mean the cycle has ended. History shows us patterns. Prices rise, peaks form, corrections happen, and then the cycle continues. Past behavior is not a guarantee of future results, but understanding patterns gives us an edge. Markets, stocks, real estate, commodities, and crypto all move in a rhythm. Rise, peak, adjust, rise again. Bitcoin follows this rhythm too, and when hype spreads, retail investors often enter without strategy. Institutions behave differently, with patience, long-term perspective, and strategic positioning. Understanding how each participant moves can inform our choices, but it does not promise gains. Since 2025, Bitcoin has followed its historical cycle, roughly 3 years of rising prices followed by periods of adjustment. Factors like the halving, which reduces new supply, influence these cycles. Today, the market shows gradual measured growth, not wild spikes, a pattern many attribute to institutional involvement. Here's what this means in practical terms. A plausible correction could bring Bitcoin down to around $75,000. This is natural, part of the cycle, and not a failure. Meanwhile, historical patterns suggest the next major peak could reach around $150,000. The probability of a recovery and new highs is significantly higher than a drop to $55,000 or lower. So what do we do with this information? We prepare strategically. Understand the cycle. Focus on historical patterns, not hype. Identify the current phase because this helps put price movements into context. Observe institutional activity and don't rely solely on media narratives. Study market logic and look for patterns without assuming outcomes. Protect capital because decisions driven by fear or euphoria are risky. Corrections are part of the natural rhythm. If Bitcoin dips to $75,000, it could be a strategic entry point, positioning us for the next surge toward $150,000. The key is discipline. Recognize the dip, position strategically, and avoid emotional reactions. Remember, cryptocurrency investing is volatile. Prices can fall or rise dramatically, and you could lose part or all of your investment. Nothing here is financial advice. Always do your own research and consider consulting a regulated professional before taking action. Right now, the choice is clear. Do we get swept up in noise, or do we focus on analysis, strategy, and disciplined decision-making? Cycles repeat. Volatility exists. But with clarity, preparation, and strategy, we ride the wave, not get crushed by it. This is how we navigate the Bitcoin cycle responsibly, with awareness, strategy, and focus on the next opportunity. Let's get real. The way institutions play this game is completely different from what most retail investors do. While the crowd chases short-term spikes, institutions think long-term. They act with patience, discipline, and strategy. They don't make impulsive moves, and they aren't trying to double their money overnight. Here's how they often operate, based on observation, not guesswork. Gradual accumulation. Instead of dumping huge sums at once, institutions build positions over time. This keeps the market from spiking too quickly and allows them to enter quietly. Patience through consolidation. They take advantage of periods when the market is calm, letting prices settle. Weeks or months of sideways movement. That's when they quietly strengthen their positions. Liquidity timing, because when more participants are active, there's more liquidity. That's the perfect moment to buy or sell without causing dramatic swings. Repeat this process over months or years, and what do you get? Those step-like staircase patterns on Bitcoin charts, slow, steady growth punctuated by pauses. Key insights to remember. Institutions can accumulate without spiking prices. Their actions are largely independent of media noise or retail sentiment. When retail attention surges, often coinciding with hype and price peaks, institutions can strategically exit, capturing gains. Here's the connection to the $75,000 to $150,000 framework. A dip towards $75,000 could represent a natural correction, a moment for a strategic positioning rather than panic. The next major peak, historically aligned with the cycle, could approach $150,000. Institutions are thinking in these terms, balancing accumulation and liquidity, and that's the rhythm the market often follows. The lesson? You don't need the resources of a giant to succeed. You need awareness, patience, and strategy. Don't chase headlines. Don't follow hype blindly. Learn the flow. Understand human behavior, fear, greed, euphoria, and position intelligently. Markets are volatile. Crypto prices can rise or fall quickly. You could lose some or all of your investment. Nothing here guarantees results. Success comes from education, observation, and disciplined action. Understand how institutions behave, respect the cycle, and use corrections like a move toward $75,000 as potential opportunities, not reasons to panic. That's how we approach the market strategically, smart, prepared, and ready for the next wave toward $150,000. Let's be clear. Bitcoin has evolved, and institutional participation has changed how the market moves. Cycles may look different, but much of the hype online is designed to grab attention, not to inform. You've probably seen headlines like, "The Bitcoin cycle is broken." No more big corrections. We're entering an infinite supercycle. Institutional investors will never sell. Interest rate cuts will inflate crypto all year. These claims are opinions, not verified facts, and they often exaggerate risks or opportunities. They can push people to make impulsive decisions, especially if they are new to investing. Here's the reality. Bitcoin experiences periods of rapid growth followed by natural corrections. Historically, these adjustments have ranged 30 to 50%, meaning a move towards $75,000 is plausible, even if the cycle is ultimately aiming toward a higher peak near $150,000. Key takeaways to keep in mind. Don't make decisions based solely on hype or social media. Understand that all cryptocurrency investments are volatile and can result in losing some or all of your capital. Use historical cycles as context, not a crystal ball. They show patterns, not guarantees. Focus on patience, strategy, and risk management, not chasing short-term gains. Corrections aren't failures, they're part of the natural market rhythm. The people who succeed are those who see opportunity in the dip, understand human behavior, fear, greed, euphoria, and make decisions with strategy, not emotion. Remember, this is educational guidance, not financial advice. Nothing guarantees profits, but awareness and disciplined strategy help you navigate volatility thoughtfully. Here's the truth. Institutions almost always enter the market before retail investors. They have access to more information, deeper analysis, and often long-term strategies. And most importantly, they act with patience, not impulse. While the crowd is glued to charts trying to chase the next spike, institutions are quietly building positions over time, accumulating strategically without drawing attention. When market euphoria hits, prices rising fast, social media buzzing, and retail investors rushing in, institutions often find high liquidity. That's the moment they can buy or sell efficiently without moving the market too drastically. How can we observe this without guessing exact prices? Look at market signals. Search trends. Track Google searches for Bitcoin or Ethereum to see retail attention. Wallet activity. Monitor new wallets and wallets with positive balances for increases in participation. Exchange metrics. Watch app downloads or trading activity to spot shifts in retail engagement. These signals provide context, but they don't predict specific price movements or guarantee profits. The market is volatile and losses are possible. A key insight: when broad retail attention rises, it's not just Bitcoin, altcoins may also move, creating additional opportunities. Awareness of market-wide trends allows for strategic, informed decisions, not reactive moves. Remember, the market doesn't care about hype, fear, or emotion. It rewards those who observe, plan, and act strategically. Understanding how larger investors behave can help us position ourselves thoughtfully, manage risk, and potentially benefit from corrections, like a dip towards $75,000, while keeping an eye on the next potential peak near $150,000. Key lesson: watch the signals, learn the rhythm, and act with awareness. Discipline, strategy, and patience are what separate successful participants from those who react impulsively. Let's wrap this up and focus on what truly matters. Some common beliefs. The cycle could be broken. Institutional investors might not sell. The market is different now. Yes, Bitcoin exists in a more mature environment. Companies, governments, and large funds are participating. But here's the truth. What drives Bitcoin is still human behavior, fear, greed, euphoria, and uncertainty. As long as these emotions exist, market cycles will continue. Cycles may smooth out over time. Corrections may be less dramatic. Periods of stability may last longer, but to completely break the cycle, that would require humans to stop reacting emotionally, and that's unlikely anytime soon. Some think Bitcoin cycles are pre-programmed as if the market follows a coded script. In reality, it's economics and human psychology. Halving events, when new Bitcoin issuance is cut in half, reduce supply, increase scarcity, and historically contribute to market cycles. Bitcoin is becoming scarcer every day. Millions of coins are lost forever, and mining is expected to finish around 2,140. Each remaining coin has the potential to hold greater value because fewer are available. Information travels faster today. People are more informed. Buying Bitcoin takes seconds on a smartphone. Cycles aren't erased. They may just move faster. Retail behavior still influences the rhythm. Institutional investors also vary in strategy. Some think long-term, companies like MicroStrategy, El Salvador, Metaplanet. Others adjust holdings depending on market conditions, BlackRock, Fidelity. So when institutions sell, it doesn't mean all at once. It means strategic profit taking as always. Here's the critical takeaway. Understand the cycle. Recognize which phase we're in. Act strategically, not emotionally. Corrections happen. A drop towards $75,000 is plausible, but historical cycles suggest the next major peak is more likely around $150,000. This is not a signal to panic, but an opportunity to position wisely and strategically. The typical investor loses because they chase quick gains. Smart investors know Bitcoin is a marathon, not a sprint. Key takeaway, don't fight the cycle, but learn to surf it. Cycles may change shape, but as long as fear and greed exist, the market will continue to follow patterns. At Millionaires Gold, we focus on understanding the game, acting strategically, and preparing for opportunity. The next wave is coming, and we'll be ready. This is how we think. This is how we act. This is how we stay ahead. MillionairesGold.com. Be one of them.